Hi, good evening, everyone, and thank you for being part of our celebrations tonight. You know, Rahul talked about how we got started. It was a product we had no experience of. Our investors had not heard of. But we knew from the experience of the US market that there was a massive opportunity, and we said, let's bring it to the founders here in India. And our first fund was meant to be 300 crores. You know, Rahul speaks well. You just saw him speaking. We raised 500 crores in that first fund. And that was also the time that family offices had just begun to emerge. And there were barely, I think, 5 family offices at that point in time. Today there are about 750. It's fashionable to have a family office. But we had the privilege of working with some of them who have continued to be investors in our funds in the last 10 years. And as we have institutionalized, they have also institutionalized. And today, for the panel, we have 2 of India's largest family offices, the most institutionalized family offices, led by 2 very senior CIOs. I'd like to welcome Ramesh Sharma, representing the Havells family office. And then I'd like to welcome Nitai, Utkarsh, who represents the Eicher family office. You know, these groups represent revenues of nearly 25,000 crores. They've been around for 50 years. They are category leaders in whatever they do. But what is most impressive is they've run their businesses with great governance, and they are corporates and business groups that people look up to. They are gold standards in how to conduct a business, how to treat employees, how to treat investors, and so on and so forth. And I'm sure this is going to be a very interesting conversation tonight. We are actually very privileged that these 2 family offices, they actually, or these 2 CIOs never speak at any panel. But they agreed to speak with us. Thank you. Thank you, please. So I have a few questions, and I will not necessarily ask the same question to both of you. But, you know, having had the opportunity to understand how you all work, I'm sure, you know, these questions will be pertinent. So the first question to Nitai. You know, family offices were seen to be preserves of wealth. And today, you know, you guys have built an institution. What has changed in the last 5-10 years? And Nitai, you yourself have been part of some very large families. You've also been a banker. And I've seen you in many, many avatars myself. What has changed?
I think the involvement of the family itself has changed, right? So and you're right, and it used to be wealth preservation because there was a generation of the family which was involved in investments or in the family office, and the objective of that generation was to pass on the wealth, and therefore preservation was important. Today, if you look at family offices, you have multiple generations involved in it. It's not just the patriarch or the generation that is the oldest, but it's the generation after that, and often kids who are growing up also involved in it. So when you talk about investments and family offices today, you talk about these multiple generations bringing their points of view into how the portfolio is managed, how it's structured. And while one generation may look at preservation, the other generation may be looking at growth. and one generation may be looking at completely out of the ballpark ideas. So it's a mix of all of that. So it's very important that family offices today are looking at a very structured portfolio approach rather than just one objective. So that, I think, has changed.
Great, thank you. Now, how differently do family offices think as compared to a VC or a PE fund?
The mindset, as far as the expectation of return, Nilesh is concerned, the thought process actually is largely the same. The quantum of expectation may vary, but the family offices look at investments actually as a underwriting or life company's business cycles versus a VC or a PE fund underwriting an exit window. So we feel that as a family office, we look at wealth preservation and consistent compounding as our primary objective, whereas the PE funds may be looking at a slightly higher return and eventual exit at an appropriate time in the fund cycle. So the mindset accordingly changes. We also tend to be light on the governance on the investee companies, where till the time there is any red flag in governance, we would prefer to take observer roles, for example, rather than taking a board seat in the investee company, work with the founders as more in a supporting role, than to be very contractual terms driven, veto driven control. So the mindset is actually emanating from the ultimate objective of our investing. I think that is the key difference which changes the mindset.
Right, and also you all have a lot of operating experience of running your own businesses, so
a lot of synergies.
There is more empathy also.
Yep.
Nitai, do you think that family offices are kind of filling the gap, created by VCP, and over the last 10 years when you see there are funds that have come and gone, funds that have gone bust. Trifecta Capital is very privileged to have reached the 5th fund in 10 years. But we've also seen a lot of offshore funds come and go. So do you think family offices are bridging some gap?
Oh, absolutely. I think it's very important to see that family offices have stepped in into a lot of situations which are not really earmarked for funds, right? I mean, it could be secondaries, it could be founder liquidity, it could be bridge rounds. So there's so many things for which, okay, now you have a lot of funds which are focusing on those specific areas. But when family offices started investing and when they started looking at the private domain, a lot of these use cases did not have any takers at all. And family offices stepped in there. They said that, okay, the founder needs liquidity. Maybe the company is valued nicely and we can give some liquidity to the founder, which the funds were not willing to do at that time. There is a secondary which is available, which is giving us the same rights. Maybe let's invest some in the secondary. There is a very attractively priced bridge round which is there. Let's do that. There is a pre-IPO structure that we can do. We can be a QIB and we can invest into that. Let's do that. So a lot of things which have now come up and funds have gone into that space. Family offices have always been agile enough to be able to find those opportunities and invest in those kind of use cases. So definitely. And I'm sure even going forward, there will be a lot of these use cases where probably family offices will be trendsetters and there will be other investors who will come in and, do a more institutional job of it.
Yeah, no, I had one of the big individual investors in Bombay tell me some time ago that we are now bigger than you guys. So, I mean, these are family offices who are writing 500 crore checks to a single company. I mean, that was massive. You talked about low touch governance. How about diligence? I mean, how do family offices do diligence, which is different from a VC, PE fund? And what's your portfolio construction approach, or you don't look at a portfolio at all, and it's more opportunistic, whatever makes money, we are happy to invest?
The diligence, Nilesh, now all the structured family offices like ours have actually moved towards benchmarking ourselves at an institutional level diligence standards, wherever we are doing a direct investment or a large co-investment. So I would say we also work with big fours and, in terms of financial and commercial diligence and legal diligences. When we are doing a small minority investment along with a larger one, then we would tend to rely on the lead investor's diligence. But when we are leading the investment, then our diligence is almost at par with the institutional grade diligence, I would say. And in terms of portfolio construct, I think all the well-structured family offices now have a clear investment allocation plan, which is approved by the stakeholders, which is aligning the risk appetite of the family with the objective of investment manager and investment portfolio. And that is the diversification, the mix between various assets classes is very well laid. So it doesn't matter if the wealth under management, AUM under management is X or 100X. The allocation as per the risk appetite of the family is already fixed, and accordingly it can be looked at deployment.
Fantastic. So do you outsource your diligence, or have you built a team internally to do the diligence?
So we work with the partners. We rely on the big diligence partners, as well as we supplement that with our own market checks, commercial promoter level checks, our own relationship, working with partners like yourself who might have relationship with those companies on the venture debt side, and supplemented with the third party diligence. So that is there. So I think I see more and more structured family offices aligning themselves to the institutional grade diligence,
which is great.
Yeah.
And therefore,
while maintaining the flexibility which comes naturally to a owner decision driven investment decision. So we have, in terms of diligence and our own institutional framework, we are now benchmarking with the established funds.
Fantastic. So Nitai, when you look at an opportunity, what weighs more? Financial return, strategic relevance to the family's core business, legacy impact? How do you balance some of these aspects?
So it's actually a mix of all three, right? And the trick is to figure out that you're not making the mistake of trying to find all three in the same opportunity. You should be very clear that this is why you're investing in a particular opportunity. So while these are three core objectives, of course, so there is that legacy and impact that you want to create and leave behind as a family to the next generations. There is, the capital growth, financial returns, and there is the strategic alignment, but they are all very separate objectives. And when we are looking at opportunities, we are clearly saying that, okay, this is the core reason why we are looking at this opportunity. And therefore, we are evaluating that from that perspective. It may just happen that, okay, something might check a couple of boxes, but we are very clear that the core reason of investing in this opportunity is one of the three and not a combination. So that's basically...
Makes sense. So, you did talk about the level of diligence, etc. There is a feeling that, amongst founders and VC community, that easier to raise capital from family offices. Why do you think that perception has gotten created when the level of diligence, at least you guys do, is pretty intense? And I'm sure you work with other family offices. Do you see this thing, or it's just maturing of the ecosystem and eventually it's going to get tough?
Yep. I think this perception is largely created because of some of the strengths which the family offices have in terms of flexibility, in terms of speed of, because we have a shorter or a leaner approval matrix, and in terms of the sectors which we understand, if there are, we don't work with a very hard-coded checklist to do the investment. So while the diligence will be outsourced, but we may take certain things, despite there are some issues which may take more time depending on the requirement of the transaction and the founder. So I think this perception has got created because of some of the inherent strengths which a family office brings. But as far as I, as a professional, look at it, the family offices actually are providing the personal capital vis-a-vis the pooled capital in case of a fund. and the tolerance for a capital loss is actually much less in a family office. And in terms of there are compliance or governance red flags, the exit and corrective decisions will be much more sharper and faster in case of a family office. So I actually, from this side of the table, I don't see my capital as a easy capital, but that perception is good. I mean, we get access to good deals, and I think that is primarily from the strengths and agility which family offices bring.
Yeah, no, I think I've seen how your family office has institutionalized and the kind of talent that is available for decision making and advisory is just fantastic. Nitai, where do you see the biggest opportunity today? Private markets, pre-IPO, secondaries, public markets, and also why?
So I think private markets is a big opportunity for sure. But what we have seen is that there is a big difference between the performers and the non-performers. And it's very important to be able to really pick the winners. And you can't do that at all times. But if you have the right kind of diligence framework, if you have the right kind of evaluation framework from a family office perspective, and you're able to pick mostly winners, then I think private markets is a great opportunity. And when I say private markets, it's both equity and debt. I'm not just referring to equity alone. Public markets is, of course, the core of the portfolio for most family offices, and that will continue to be so. And there will be opportunities at different pockets of time which will come in, and family offices will leverage on their understanding of public market investing, which goes back obviously much longer than their understanding of private market investing. So they will continue to invest in public markets as a core of their portfolio, but private markets is where the big opportunity lies. Having said that, like I said, the caution that I think family offices are trying to bring in to private market investing is really spending more time evaluating people and trying to figure out, at least try and omit cases where loss of capital could be a factor. So that I think is very critical for family offices. Loss of capital is something that we can't really stomach. Loss of return is fine.
Sure. Now, Ramesh, you and I talked about some structured transactions.
Right.
So this question is around that. Are you seeing more family offices participate in structured deals, whether it's debt, mezzanine, revenue linked, rather than just pure equity?
Absolutely. So this is getting driven from primarily, Nilesh, two factors. One, most structured family offices are working with an investment allocation, which has an allocation to equity as well as fixed income. And within fixed income, there are allocation mostly towards different classes of fixed income. So where the structured finance, which offers slightly higher return in terms of fixed income return and some upside in case of equity linked exits, is finding a place in that allocation. Number two is the quality of managers who are managing family offices now. There is a deeper understanding of structured credit, as well as the opportunity to participate in these, and the absence of banks and NBFCs who were earlier dominant in this structured financing is another area which has contributed to these kind of deals being accessible to credit funds, and then in turn as co-investors to family offices.
Yeah. Nitai, there is, and you've been in multiple family offices where the young generation is now slowly stepping in, getting involved, voicing their views. Are you actually seeing, youngsters being more excited about tech, startups, and kind of influencing where the family office capital gets allocated?
Yes, and very remarkably. And in fact, in some of the family offices, the way this is playing out is that there is a separate allocation that the family offices have carved out specifically to take some of these bets, right? Because maybe the earlier generations don't understand these asset classes so well, maybe they don't understand these themes so well. So they're not comfortable yet with completely orienting the strategy of the family office portfolio towards those kind of asset classes or opportunities, but they're happy to say that, okay, you've come in with an idea and you feel that this is where we should invest. So why don't we put aside, let's say, 5% of the corpus and let you, work on these areas. I think that is something which is becoming a common strategy for a lot of family offices, where the young ones or the next generation is being given that responsibility with a smaller portion of the corpus to deploy it into such areas and show that these are actually areas where returns can be generated consistently. And then as they prove themselves and their strategy, the allocation increases.
Yeah. No, we're seeing that in many family offices that we work with. Ramesh, family offices have evolved over the last 10 years. I know many family offices have their share of grief and bad investments. What has generally been the experience of family offices, and what are some of the lessons learned in general by family offices and maybe, you guys?
So the lessons in the market and investing are continuous. I feel a lot of lessons the family offices have also learned over last 5 years, especially after the COVID lockdown opened and lots of liquidity was there. So I think, to name a few, I would say benchmarking our investment entry valuation to VC determined valuation in many cases, which was in the bull phase when the valuations were driven by what will be the next round and next round and next round, and assuming that this bull run will continue and the valuation will continue to be driven up linked to the top lines. I think that was one of the key lessons learned, that when the tide turns, the valuations can just evaporate. Number two, I feel the timing of exit. Because the character of the family office investment is patient, long term, when the businesses are doing well, despite seeing an IPO and PE funds exiting at the time of IPO, in certain cases we decided that let us continue, and only realizing that the markets had peaked out at the time of IPO, and we were actually left with the lock-in of 6 months, and then the prices reduced. Third very important one, I feel, is the third key lesson which comes to my mind, exit and the valuation, and also mixing, actually what Nitai was also saying, which you asked him earlier, mixing the strategic intent in an investment with the economic return. So in many cases the strategic synergy did not play out, but the capital risk played out. So having a very clear outlook at the time of investment, that if there is an strategic intent, the first focus should be on a risk adjusted return, and the strategic synergies can only provide us more flexibility in terms of time horizon to hold and IRR expectation flexibility, but not the first the criteria to invest from a family office. If there is very strong strategic intent, then let the operating entity only in the group take that call rather than family office, because if the synergy does not play out, then the return on that investment may not be as expected in many cases. So this is what 3 learnings which came to my mind actually.
No, I think they're very, very relevant. This is an out of syllabus question to both of you. Views on gold and silver going forward.
No, I've always felt so. Okay, I have different views on gold and silver. Gold, I've always maintained that it's not a strategic asset class. It's a tactical asset class, and it's a tactical allocation that you make to gold when you feel that there is uncertainty, and which of course has been there ever since Mr. Trump became president, and of course there are a lot of other things which are happening around the world which is adding to this. So from that perspective, gold is definitely something that you keep picking up and very opportunistically keep looking at it in terms of when to find an exit. It's not something where I would say allocate 5% of the portfolio and forget about it. unlike equity. So it's not a part of my strategic asset allocation. It's more a tactical play. Silver, I am extremely confident, and this is my view, of course, that it's a commodity. It's not a store of value. It may have gone up along with gold for whatever reasons, but at the end of the day, it's a commodity like many others. So if you have a commodity play in your investment strategy, of course, silver is an important commodity. It has important industrial uses. But if you don't, and if you're looking at silver as a store of value like gold, then you're definitely going to, get beaten somewhere. So you have to be very clear why you're investing in these two metals. Gold, of course, store of value. Silver, industrial use only.
Ramesh?
I largely agree to what Nitai said. Gold, I feel, as a part of our investment allocation policy itself, we have certain allocation, and we feel that it will continue to have that appeal of store of value, as well as hedge against inflation and currency depreciation and geopolitical uncertainty, and should do well in medium to long term. That's what we feel, and we've been building that position. Silver is very volatile. I think in many ways unsuitable for the family office kind of investing, unless there is very sharp trading call taken and timely exits, which again is a factor of market, but it will continue to have extremely high volatility. So be more comfortable with continuing with gold long position than silver.
Very interesting. Thank you so much, gentlemen.
Thank you very much, Nilesh, for
really
having me.
appreciate it.
Thank you. And congratulations on your 10th anniversary.
Absolutely. Congratulations.
Thank you very much.
Thank you. We have a very interesting founder panel coming up. Our founder panels in all three cities, in fact, our panels in all three cities are very different. Bangalore, the panel discussion on LPs was more about endowment and philanthropy. This one, we just saw how family offices are institutionalizing themselves. And the founder panels are on how a founder has taken companies public, what he learned, the trade secrets. And then, of course, we have two companies from our portfolio that will be going public very soon. So, Rahul.
Thanks, Nilesh. Thank you. We're just going to try and get a few more people in from outside. So I think Shibam is on his way, caught in the famous Gurgaon traffic. But in the meanwhile, I'd love to get a couple of other people on the stage. So maybe start with Abhiraj. Abhiraj is the co-founder and CEO of Urban Company. Many of you know the business. I'm sure we all use it. I've known Abhiraj. I've had the pleasure of knowing him for 11 plus years. It was called Urban Clap. And I did not invest as an angel. Shame on me. But please join the stage. We need one more chair. And then we also have Uttam, who's here. Uttam, we've also known for a long time. He's very kindly flown in from Europe about 1.5 hours ago to join this discussion. Uttam, please come. Grab a seat there, please. Is Shibam here? There he is. Just in time. Come. Thank you. Come sit. All right. This is the multi-billion-dollar panel. Just getting started. So I guess we had a little bit of a conversation about what it's like to take a company public and what comes beyond that. And I guess, Abhiraj, we'll start with you because you've been in the hot seat just about, a couple of months ago? It feels like just, yesterday, but maybe you can start by just describing, what the emotion was like. I know it's obviously been a long journey, but what did it feel like to finally get to that point and beyond? Maybe just a sense of the emotions and just the visceral feeling of taking that step.
I think you're so busy in the process, and it can be a long process to take a company public, that one doesn't actually have the time to reflect and think about what it means until it actually happens. So for me, I think it was like barely minutes before the ringing of the bell when it finally started to sink in, and Varun, my co-founder, went and made a fairly emotional speech. Up until then, it was like process, 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 and then suddenly it became real. There is, it's a moment of a lot of gratitude for all the stakeholders who've helped us get there, but there's also a sense of deep responsibility because it's a new journey you're starting. You are now taking public money, and you have to almost sort of reset the clock back to day one, and then look at the next decade or more, and live up to that responsibility.
Great. And I know he truly believes that, because when I went to his office about a month ago, right at the reception, there was a glass bowl and it had a sign that said, if you talk about the price of the share of the company, put 100 rupees inside this. So there was no conversation about the share price in the office or at anywhere else. So I think they truly are on a very interesting journey. I guess, Abhiraj, maybe I'll just stay with you for a minute. When you think about building sort of public company muscle, when did you start to build that muscle? And was there, do you remember when you said, okay, we're going to start that journey now? And what did it change about how you ran the company?
I think for us, I would say about 3.5 years prior to going public, start of 2022, we got an independent board on board, and we had 4 independent directors. I think that was a turning point because we started to operate as a quasi-public company with, an audit committee, NRC, stronger governance, etc. And one of the things the independent board kept telling me told me, Abhiraj, you have to get to the point where your numbers, your controls, they speak for themselves. The difference between being public and being private is that a lot of the heavy lifting and the storytelling is done by you as a founder when you're private. But when you're public, the data, the controls, the governance needs to speak for itself, not the founder. I think I found that very useful.
Uttam, just coming to you, obviously you're quite far along in the process, but the company's also grown, through acquisitions and things like that, and almost gotten to scale where it's ready for this kind of event. Did you have enough time to prepare for this, and do you feel like there's a little bit more work to be done, or you're ready to go?
So if you look at my journey, it's a slightly interesting journey because I saw IPO before starting up.
Yes.
So my tryst with this sector was as an IPO banker. I was advising an exporter wanting to go IPO. And I was thrown into this roadshow, meeting hundreds of public market investors, trying to sell a seafood business. So my lesson from that entire journey was that IPO-ready company kind of has 3 things to solve for. One is, at least that's very relevant to the industry that we belong to, right? One is the predictability of earnings. Second is having the ability to scale. And like what Abhiraj is saying, can you sell something 10 years out, 20 years out? Is the vision durable enough to last through cycles, right? And third, the whole ROCE, right? How efficiently are able to do this. If you see predictability as a problem statement is actually very foundational. It's a design problem. It's not something one day I wake up and say, look, now I want to go and list the company. I'll make my cash flows predictable, right? At least for my industry, it wasn't that. So for us, like I said, the diversification of various pools of value was at the design stage of it. And in that, clearly we had to be a multi-geo, multi-species, operating out of multi-origins. And that we couldn't do it organically. So we did that in an inorganic fashion, at least one side of the platform, which is the demand side of the platform. So to that extent, all of these acquisitions have not been something that's been opportunistic. So these are all very top-driven. It's like a puzzle with pieces falling in place. So to that extent,
we are at a point where we have done like now 8 or 10 acquisitions, and it kind of fills up a portfolio, and we are able to deliver a year of predictable earnings. For me personally, that was the point where I said, yeah, maybe now we can look at a public journey. And thanks to Trump, we also got tested. So there's enough and more excitement at the macro level. And we could survive through all of this thanks to the design choices we had made at the business model level, which is we didn't depend on a particular geography, particular origin, particular product, right? So that to me was the point at which we said, yes, the playbook has been very acquisitive, but the ultimate outcome of what platform represents, which is ability to deliver predictable outcomes in an industry like seafood, which is 600 billion, so scale is a solved problem. And hopefully we'll do it in a productive manner, which is ROCE being the possibly a proxy. So that's what gave me the conviction that yes, we could be ready to list. Yes, we were just I think the first time I spoke about it was when we were a 3-year-old company. We started in 2020. I remember 2023 board meeting, I brought this up. And you can imagine the reaction of VC investors, like, dude, get your basics first, right? But yeah, I think thankful that we filed our document like last year, and we are going through that motion process, all in 5-6 years. Because I would say the start that I had, almost say that I had the benefit of having the question paper, so to say, of IPO before actually building the business.
Oh, that's super. I think the secret power of being on the sell side and the buy side is quite a unique skill that you had. I guess, Shibam, just coming to you, obviously, I think Uttam made an interesting point about design choices. You began with a single category business. You've sort of dominated that category. Now you've added a bunch of other categories. You also have a plan to go public in a finite period of time. Where do you draw the line? Because, to the point Uttam made about being predictable and having enough momentum, maybe across different categories, at some point you stop saying, okay, this is enough. We've got 3 things on the table. We need to continue to bring those out, and then we'll add a few more. Or do you keep going? And how do you think about the design choices of a multi-product business?
Hi, Rahul. Thank you so much for having me here, and extremely sorry for being on the last,
no, you got here
the
just
last minute. Good traffic. I can blame it on. I think it's a very important question. And if I look back to maybe somewhere like 2.5 years back, when we started discussing internally about whether we should go public or not, the first thing that we started discussing and debated is basically how a company in our industry should look like when we go public. That means a certain scale. Should it be single category? Should it be multi-category? Should we venture out into something else at this point in time, or should we wait for some time? So some of these strategic calls we made at that point in time, and clearly multi-category was one option. And within multi-category, we figured out that a certain scale of new category is important. For us, that magic number was just 100 crore. But for that, which is important categories, all of this we figured out. We figured out that I need to at least have 1 or 2 more categories, which is 100 crore plus, and a certain growth number. So that probably give us a right to call ourselves as a multi-category business. So that is one line that we drew at that point in time. We also decided to not get into a much bigger and much larger category, which probably would have derailed our profitability journey by 2 more years. So we said no to that. But while saying no to that, we made sure that the choice of public or private should not decide the potential of a business. And hence we debated saying that if we delayed by 2 years, will it, is it a business potential loss, or it's just a time loss? I think the answer was more of around time loss, and hence we figured out that let's delay that by 2 more years. So I think some of those decisions we made as a first step when we thought about being public in a couple of years from there.
Super. That's very helpful. So Abhiraj, you've had the challenge of sort of being the N of one business for some time, and I'm just curious, you began that early and you've stayed with it. What was it like to educate, investors on the business model and just the challenges of getting them to appreciate that you're more than a services business?
I think it definitely needs a lot more effort than what a company that has clear comparables requires. But what I found useful, Rahul, was that it also allowed me to narrate the story the way I am seeing it, with the metrics that I feel are sort of critical to my business. So in some sense, it was a white canvas, which I could paint on. And I'm sure at some point in the future, maybe 5 years out or 10 years out, there'll be other companies in our sector that will go public. They will always have to align to the metrics and the narrative that, we have defined as the market leader. So as a market leader, the onus is on you to define the market, talk about what you're trying to create, but it also comes with freedom. And that freedom allows you to tell the story the way you want to, the way you see it, the vision that you want to paint, and the metrics that you want the market to choose to follow. So I prefer this to, being a follower to some other company and their narrative and their metrics.
That's super interesting. We also had the luxury with venture debt of defining, in a way, the foundational structure, the idea of a coupon instrument, quarterly distributions, equity instruments attached to it. Much of this was not seen in the market 10, 11 years ago. So I think we also enjoyed setting the narrative, and hopefully that becomes the standard by which everyone is measured. Uttam, just coming to you, as you think about just the cadence of running a public company, you're maybe a couple of quarters away or maybe sooner, but how do you think about, sort of that bench that you need to run, the metrics you're tracking? What are sort of the North Star things that you've had to educate investors about? Because again, in your category, there aren't that many listed comps in India, maybe 1 or 2. So how have you thought about guiding the market?
I think I'll answer this with a caveat that obviously we are hugely work in progress. As a founder, I'm work in progress. There's a big step to still cross. But just sharing my mental model, ultimately it's a bunch of cash flows discounted at a certain risk rate. And can I get the audience to appreciate these 2 aspects, right? It comes down to that. Otherwise, it's a very complex business. We are a global business. We are in so many countries. It's acquisitive on one side, it's tech on the other side. We call B2B platform. We are a packaged food business, right? Otherwise, it becomes extremely complex. So ultimately, at the core of it, like I said previously, like, am I a predictable business? Basically, can investors play with me without as much surprises? Is there a large outcome that they can expect? Basically, is there scale in our business? And am I doing this in a manner which is very efficient compared to my competition, which is in a way return on capital employed? And all of these 3 things is also something that I have learned and come to this because of my sell side, buy side, all of that I've seen, right? Also, I think it may be, I'm sure a lot of market participants are there. India is a sucker for productivity, right? Indian stock market. Like if you compare India, China, and US, if you just see the GDP to stock market transmission, right? You will see that China is more scale oriented. India is more return oriented, ROCE oriented, right? So the bar is quite high. So then it's about translating the metrics to be able to showcase these 3 things, which is predictability, scale, and return. I think the difference is when you move from a narrative-driven fundraising, which is largely the VC realm, to a kind of a, like he said, financial metrics-driven fundraising, the lead versus lag indicators that you see, right? So that's something that we'll have to obviously refresh. So I think that's on the metrics side. Now coming to the cadence and the actual aspects of it, I would say, in my view, there are three parts to this. First is your CFO is super important. He is your lieutenant in this. So better get a guy who is really good. Second is auditor. I think as a fast growth startup founder, we kind of live 24 months out, whereas auditor is asking you 12 months behind questions. And for all practical reasons, it seems like noise to you. But they are a very, very big component of this entire journey. When everything goes well, it's not an important aspect, but when something doesn't work, it becomes a very frustrating thing to work with. So auditors need to be a strong focus on that. The third one is audit committee. Independent directors do help, but having that cadence of controls, etc., getting reviewed. So for me, these three becomes kind of a starting point. CFO followed by a auditor, and having that relationship and ensuring that he really doesn't have as much problems with your business, and then obviously the audit committee to run these things